Stop looking at the ticker tape. Stop refreshing the price of silver every 5 seconds. The flickering numbers on your screen are not the story. They are merely the symptoms of a dying system. As we stand at the threshold of 2026, we are no longer asking if the financial architecture of the world will change. We are witnessing its collapse in real time. For 40 years, the gatekeepers of Wall Street have fed you a steady diet of lies. They told you that gold was a pet rock. They told you that silver was a relic of the past. They told you that the US dollar was the only safe harbor in a storm. But as the clock strikes midnight on the era of cheap debt and fiat supremacy, those who believe the lies are about to be stripped of everything they worked for. We are currently entering a period of unprecedented financial gravity. The global debt now stands at a staggering $335 trillion. In the United States alone, the national debt has surged past $40 trillion. To put that in perspective, the government is now spending more on interest payments to service that debt than it spends on its entire defense budget. This is the mathematical end of the road. It is an exponential spiral that cannot be fixed by raising taxes or cutting spending. It can only be resolved through the destruction of the currency. This is not a conspiracy theory. It is an accounting certainty. The question you must ask yourself right now is not what the price of gold is today. The question is, do I have enough? And for the vast majority of men watching this, the answer is no. You have been conditioned to accept a 5% allocation to precious metals as insurance. I am here to tell you that in the world of 2026, 5% is the same as zero. If your house is made of dry wood and a forest fire is approaching, a single glass of water is not insurance. It is a consolation prize. We are seeing a massive transition. The great reset of value has begun. While mainstream analysts spent 2024 and 2025 telling you to chase the latest AI tech stocks or speculative meme coins, the smartest money on the planet, the central banks of the East were quietly vacuuming up every ounce of physical gold and silver they could find. They know what is coming. They are preparing for a world where paper promises are worthless and only physical collateral matters. In this video, we are going to strip away the noise. We are going to ignore the propaganda and look at the cold, hard math of purchasing power. We are going to show you exactly why the rules of the last 40 years no longer apply. We are going to give you the specific ounce counts you need to hold to not just survive, but to thrive during the greatest transfer of wealth in human history. The window to position yourself is closing. The tide is rising fast, and the lifeboat is filling up. It is time to decide if you are going to be a victim of the system or the master of your own financial destiny. To understand where we are going in 2026, we must look at the scoreboard of the last 24 months. For years, the financial media told you that the S&P 500 was the only game in town. They told you that the stock market was the ultimate barometer of economic health. But if you look closely at the data from 2024 through the end of 2025, a different story emerges. This was the period when the illusion of paper wealth began to crack. While the nominal price of stocks may have looked impressive, their value when measured against the things you actually need, energy, food, and hard assets, began to stagnate. Let us look at the performance. As we closed out 2025, gold and silver experienced their largest gains since 1979. In 2025 alone, gold surged by over 30%, while silver went vertical, crushing the performance of almost every traditional asset class. Even Bitcoin, the so-called digital gold, struggled with extreme volatility, ending 2025 down 8% on the year as investors fled from speculative digital assets back to the safety of physical bullion. The message from the market was clear. When the system feels unstable, the world returns to the only money that has no counterparty risk. The reason for this shift is simple. The decoupling of the economy from reality has reached its limit. Throughout 2024, mainstream analysts claimed that the Federal Reserve had engineered a soft landing. They told us that inflation was under control and that the dollar remained king. Yet, behind the scenes, the purchasing power of that dollar was being systematically eroded. By the time we hit mid-2025, the average American household was spending $1,200 more per month just to maintain the same standard of living they had in 2021. This is why the gains in gold and silver are so significant. They are not just going up in price, they are reacting to the debasement of the currency. Gold is the ultimate truth teller. It is a mirror held up to the face of a failing monetary policy. When you see gold hitting new all-time highs in every major currency on earth, from the euro to the Japanese yen and finally the US dollar, the market is telling you that the faith and credit of nation-states is evaporating. We also saw a massive shift in institutional behavior. In 2020 bone, the narrative was that the US might even sell its gold reserves to buy Bitcoin. That narrative was a trap designed to keep retail investors out of the metals market while the big players moved in. Instead of selling, Central banks increased their gold purchases to record levels. They were not buying paper certificates or ETFs. They were taking delivery of physical bars. They were pulling metal out of the vaults in London and New York and moving it to vaults in Singapore, Shanghai, and Warsaw. The scoreboard is in. Real wealth, the kind you can hold in your hand, has outperformed paper promises. The era of blind faith in the stock market is over. We are now entering the era of tangible value. If you did not position yourself in 2020 bone or 2025, you are already behind the curve, but the window has not closed entirely. The move we have seen so far is just the beginning of a much larger revaluation that will culminate in 2026. If you consult a traditional financial planner today, they will likely give you the same advice they have given for 30 years. They will tell you to build a diversified portfolio of 60% stocks and 40% bonds. Then, they might suggest a tiny 5% allocation to gold just for insurance. I am here to tell you that in the economic reality of 2026, following the 5% rule is a suicide pact for your wealth. This outdated strategy was designed for a world of stable currencies and manageable debt. That world no longer exists. To understand why 5% is not enough, we have to look at the risk profile of the global financial system. We are currently facing a trifecta of systemic threats, record-breaking debt, persistent structural inflation, and a fundamental shift in the global reserve currency order. In 2025, the total global debt reached a staggering $340 trillion. This is not just a big number. It represents 3 to 4 times the entire gross domestic product of the planet. When debt reaches these levels, the only way for governments to survive is through currency debasement. They must inflate the debt away, which means the value of your paper savings must be sacrificed. Let us run the math on a 5% position. Imagine the year is 2026, and we experience a major systemic shock. The dollar loses 20% of its purchasing power in a single year, a scenario that is becoming increasingly plausible. If your 5% gold position doubles in price, you have gained 5% on your total portfolio. Meanwhile, the other 95% of your wealth, held in cash, bonds, and stocks, has just lost 20% of its real-world value. You have not protected yourself, you have merely slowed down your descent into poverty. For most men watching this, the new floor for 2026 needs to be 10 to 15% of your total net worth. If you are debt-free and have high job security, that might be sufficient. However, if you rely on a fixed income, or if you are concerned about the stability of the banking system, your allocation should be closer to 25%. This is not about speculation. It is about functional protection. You need enough upside in your hard assets to fully offset the destruction happening in your paper assets. When your grocery bill doubles, your silver needs to have tripled. When the bond market crashes, your gold needs to provide the capital to keep your family secure. The financial industry hates this advice because they cannot charge you ongoing management fees on the gold bars sitting in your safe. They want you in mutual funds, ETFs, and paper promises because that is how they get paid. They will call you a gold bug or an alarmist. But look at what the institutions are doing, not what they are saying. In 2025, gold surpassed U.S. Treasuries as a percentage of global central bank reserves for the first time in decades. The very people who manage the global money supply are ditching government debt in favor of gold. They are moving far beyond 5%. They are restructuring their entire reserve strategy for a post-dollar world. In 2026, you must act as your own central bank. You cannot outsource your safety to an industry that is incentivized to keep you in the burning building. It is time to move past the token 5% allocation and build a fortress of real value that can withstand the coming volatility clusters. You do not want to be the man who had the right idea, but didn't have enough size to make a difference. One of the greatest deceptions of the modern era is the idea that gold and silver do not pay a yield and therefore do not build wealth. Critics call gold a pet rock. They say it just sits there. But this argument ignores the most fundamental law of economics, the preservation of purchasing power. To understand the value of metals in 2026, we must stop measuring wealth in falling paper dollars and start measuring it in the things that matter to your daily life. When you do this, you realize that gold and silver do not just hedge against inflation, they actually capture the benefits of human progress and technological deflation. Let us look at a symbol of modern productivity, the iPhone. In 2007, when the first iPhone was released, it cost $599. By the end of 2025, the latest premium model costs nearly $1,200. If you saved in dollars, the price of this technology has effectively doubled. You had to work twice as many hours to buy the same category of product. However, if you price that phone in gold, the story is the opposite. Since 2007, the price of a new iPhone has actually decreased by 75% when measured in gold. It has decreased by 68% when measured in silver. This means the man holding gold can now buy 4 iPhones for the same amount of metal that bought him only one in 2007. Gold allowed him to participate in the technological advancement of the century, while the dollar saver was robbed of it. But an iPhone is a luxury. Let us talk about the single most important asset for any man, the roof over his head. Everywhere you look today, people are complaining that housing is unaffordable. They say the market is in a massive bubble. In terms of US dollars, this is absolutely true. But in terms of real money, housing is actually in a long-term depression. We have analyzed the numbers going back to the late 20th century. Between 1990 and 2006, the median US home cost approximately 457 ounces of gold. That was the benchmark of value for decades. As we enter 2026, something extraordinary is happening. With the surge in gold prices and the stagnation of real estate in real terms, the price of a median US home has collapsed to just 95 ounces of gold. That is a 53% decline in the real cost of housing since 2007. Today, 95 ounces of gold is even cheaper than housing was during the peak of the 1980 gold bull market. In silver, the story is equally compelling. The median home priced in silver is now approaching 6,400 ounces, which is the exact local low we saw during the silver peak of 2011. What does this tell us for the year ahead? If you are sitting on cash in a savings account trying to save for a down payment, you are running up a down escalator. No matter how much you save, the house gets more expensive because the currency is dying faster than you can earn it. But if you are saving in gold and silver, the house is getting cheaper for you every single day. The goal of your allocation in 2026 is not just to look at shiny coins. The goal is the ultimate trade. You are accumulating metal now so that in the near future you can trade a relatively small stack of gold or silver for a 4-bedroom home, free and clear of any mortgage. This is how the gap between the rich and the poor is created. The masses focus on the dollar price of the house, which goes up. The elite focus on the gold price of the house, which goes down. By holding metals, you are positioning yourself to be on the right side of this massive transfer of wealth. You are capturing the productivity of the world while others are watching their labor being stolen by the silent tax of inflation. Now that we have established the systemic risks and the preservation of purchasing power, we must move from theory to execution. The most frequent question I receive is, exactly how much metal do I need to be safe? While everyone's financial situation is unique, we have developed a baseline survival metric for the era of 2026. We call it the 5 and 200 rule. This is the absolute minimum threshold for any man who wants to ensure his family can weather a total systemic reset. This rule requires you to hold 5 ounces of physical gold and 200 ounces of physical silver. To understand why this specific ratio matters, we have to look back at the history of this target. When we first introduced the 5 and 200 rule in 2021, that total stack cost approximately $14,300. At the time, we calculated that this amount would cover roughly 3 months of essential living expenses for the average American household if the banking system were to freeze or if the currency experienced a rapid devaluation. Fast forward to December 2025. That same stack of 5 ounces of gold and 200 ounces of silver is now worth nearly $34,000. If you followed this rule 4 years ago, your purchasing power did not just survive, it doubled. While the rest of the country is struggling with a cost of living crisis and complaining about the price of eggs and fuel, you are sitting on 6 months of financial runway instead of 3. You have effectively bought yourself time and peace of mind. But even though the dollar price is significantly higher today, the rule remains just as critical for those starting now. If you are starting from zero in 2026, your first financial goal, before you buy a single stock, before you invest in crypto, and even before you pay off your mortgage early, is to secure your 5 and 200. Why 200 ounces of silver? Because silver is the transaction metal. If we enter a period of hyperstagflation or a digital currency blackout, you are not going to take a 1-ounce gold coin worth thousands of dollars to the local market to buy groceries. You cannot easily divide gold for small daily needs. Silver provides transactability. It is the money of the people. 200 ounces gives you the ability to navigate the underground or local economy for months. Why 5 ounces of gold? Because gold is concentrated wealth. It is your ultimate savings account. It is the portable capital that will allow you to buy assets like land or a business when the dust settles. Is it harder to achieve this goal in 2026 than it was in 2021? Yes, it costs $20,000 more in paper terms, but the cost of not having it is now infinite. We are moving into a period where the availability of physical metal is becoming more important than the price. In 2025, we saw multiple instances where major dealers ran out of stock and mints suspended production. The 5 and 200 rule is your life raft. You do not wait for the ship to sink before you check if the life raft has enough air. You secure it now, while the markets are still functioning and the delivery trucks are still running. Once you have reached this baseline, you can then begin to look at the multipliers to move from defense to offense. But until you have your 5 ounces of gold and your 200 ounces of silver, you are still vulnerable to the whims of a system that does not have your best interests at heart. For many of you watching, the silver price touched $70 an ounce in late 2025. Your first instinct might be to think that you have missed the boat. You see the chart and you think it is a bubble. But I am telling you right now, you are looking at the chart upside down. We are not in a bubble. We are witnessing the bursting of a reverse bubble. For the last decade, silver was the most artificially suppressed asset on Earth. It was the only commodity that was cheaper in 2020 than it was in 1980. While every other asset inflated, silver was held down by paper manipulation on the COMEX. But as we enter 2026, that manipulation is failing because the physical reality has taken over. To understand why $70 is actually cheap, we must look at the inflation-adjusted highs. If you take the 1980 high of $50 and adjust it for the real inflation we have experienced over the last 45 years, not the fake numbers from the government, silver would need to be over $800 an ounce just to break even in terms of purchasing power. Even if you use a conservative monetary base expansion model, we are looking at a fair value of over $100. When you see silver at $70 today, you are seeing a market that is just now beginning to correct itself back toward reality. The fundamental drivers for silver in 2026 are unlike anything we have seen in history. This is the first time we have a simultaneous explosion in monetary demand and industrial demand. On November 6, 2024, the U.S. Geological Survey added silver to its critical minerals list. They did not do this for fun. They did it because they realized the cupboard was bare. The solar industry now consumes nearly 200 million ounces of silver per year. The AI revolution, which relies on high-performance semiconductors and silver-coated connectors, is adding another 50 million ounces of demand annually. Meanwhile, global silver production has been in a steady decline for years because the grades in the mines are dropping. We are currently in a massive physical deficit. In 2025, the global silver market was short by over 250 million ounces. This deficit is being filled by draining the existing vaults in London and New York. But those vaults are not bottomless. We have seen the Shanghai Gold Exchange premiums scream higher as the East realizes that the West is running out of metal. This is creating what we call the silver slingshot. The more the price was suppressed in the past, the more violent the move will be to the upside. If you are allocating for 2026, you need to be overweight silver right now. While gold is your shield that protects your wealth, silver is the slingshot that will catapult your net worth. The historical gold to silver ratio has averaged around 15-1 for thousands of years. In the 20th century, it averaged around 50 or 60-1. In early 2020 Bond, it was over 80-1. As the ratio compresses toward its historical mean, silver will outperform gold by a massive margin. If gold reaches our target of $4,800 and the ratio drops to 40, silver becomes a $120 asset. This is not speculation, it is a mathematical convergence. $70 is not the ceiling, it is the floor. You cannot understand the price of gold and silver in 2026 without understanding the invisible war being fought for the soul of the global monetary system. We are not just in a bull market, we are in the midst of the greatest geopolitical divorce in history. For 50 years, the world operated under the petrodollar system. Saudi Arabia sold oil in dollars, the world bought dollars to get the oil, and the United States exported its inflation to every corner of the planet. It was a perfect system for the West, until it was weaponized. In 2022, when the U.S. froze $300 billion of Russian central bank reserves, the world changed forever. Every central bank governor from Brazil to Indonesia learned a chilling lesson on the same day. If your wealth is in dollars, it is not your wealth. It is a permission slip from the U.S. Treasury. In 2024 and 2025, we saw the reaction. The BRICS nations, led by China and Russia, officially began the de-dollarization of global trade. Saudi Arabia joined the alliance, and for the first time in half a century, oil began trading in yuan, rupees, and gold. But here is the mechanism that the mainstream media ignores. When China or India buy oil in local currencies, they do not want to hold those currencies long term. They convert their trade surpluses immediately into physical bullion. This is the shadow bid that has been driving the market. It is not retail investors in the West buying coins. It is nation-states settling their accounts in metal because they no longer trust the Western banking system. They are building a financial firewall. While the London and New York markets try to control the price through paper contracts and high-frequency trading, the Shanghai Gold Exchange is demanding physical delivery. We are seeing a massive migration of metal. Gold and silver are flowing out of the vaults of the declining empires and into the hands of the rising powers. In 2025, the Shanghai premium, the extra price people are willing to pay in China over the London price, reached record levels. This tells us that the physical metal is becoming scarce in the West. The East is not waiting for a pullback. They are buying at the highs because they know the paper dollar is a melting ice cube. They are preparing for a new international reserve currency, likely backed by a basket of commodities and gold. When that announcement comes, likely sometime in 2026, the dollar price of gold will no longer matter. All that will matter is who has the physical bars. If you are holding dollars in 2026, you are betting on the continued dominance of a system that is being actively dismantled by the rest of the world. If you are holding gold and silver, you are aligned with the new reality of global power. You are holding the only assets that require no permission and no counterparty. The central banks are front-running this trade. They are hoarding the insurance policy while they tell you to keep your money in the bank. Do not listen to what they say, watch what they do. They are draining the West of its real wealth, and you should be doing the same. As we stand on the doorstep of 2026, we must address the most significant technological shift in the history of money, the arrival of central bank digital currencies, or CBDCs. This is no longer a theoretical debate or a topic for fringe forums. As of January 2026, over 130 nations, representing 98% of global GDP, are actively developing or piloting digital versions of their national currencies. The infrastructure is being laid right now through systems like FedNow in the United States and the Digital Euro project in Europe. But what the central banks market as a tool for convenience and inclusion is, in reality, a mechanism for total financial oversight. The fundamental difference between the digital dollar you use today and a CBDC is programmability. Unlike paper cash, a CBDC is a digital tether directly between you and the central bank. This gives the government the power to implement policies that were previously impossible. They can enact negative interest rates, where a small percentage of your savings is deducted every month to force you to spend. They can set expiration dates on your money, telling you to use it by the end of the quarter or lose it. They can even implement carbon quotas, automatically blocking your transaction at a gas station or an airport if you have exceeded your government-mandated limit for the month. In this coming digital grid, your money is not your property. It is a database entry that can be turned off with a single keystroke. We have already seen the precursors to this, from the freezing of bank accounts during protests in Canada to the social credit systems expanding in the East. When cash is fully phased out, your ability to dissent, your ability to provide for your family, and your very freedom will be entirely dependent on your compliance with the digital system. This is where silver becomes your last frontier of liberty. Silver is the only anonymous, physical, and untrackable money that remains accessible to the average person. You cannot buy privacy with a digital token, but you can buy it with a silver coin. In a world where every digital transaction is logged and analyzed by an AI algorithm, silver allows you to transact outside the matrix. You can trade silver for a generator, for a side of beef from a local farmer, or for professional services without needing a QR code or government permission. This inherent privacy creates a freedom premium on the metal that the official spot price does not yet reflect. In a cashless society, do you think a silver eagle will still be trading at a small markup over spot? On the contrary, silver will likely trade at a massive premium in the underground or parallel economy because it represents the right to be a free human being. By 2026, holding silver is not just a hedge against inflation, it is your exit strategy from a controlled financial system. Your allocation of silver is your insurance against the digital gulag. If the power grid goes down, if the digital currency system crashes, or if you are simply locked out of your digital wallet for political reasons, physical silver ensures you still have a seat at the table of commerce. It is the ultimate decentralization of power. While the masses are led into the digital trap of CBDCs, the wise man will ensure he has a significant portion of his wealth in the one asset the central banks can neither track nor delete. One of the most dangerous mistakes an investor can make in 2026 is falling in love with their insurance policy. Gold and silver are not assets you hold forever just to stare at them in a vault. They are tools designed to carry your purchasing power through a storm. If you hold your metal for too long, you risk missing the primary objective of any wealth builder, which is to acquire income-producing assets when they are undervalued. The ultimate goal of your 2026 allocation is to participate in a capital rotation. You are waiting for the moment when dead metal can be traded for live money. To execute this strategy, you must stop looking at the dollar price of your coins and start watching the asset ratios. Professional investors and the great financial dynasties of history do not measure their success by how many fiat currency units they have. They measure their success by the gold to housing ratio and the gold to land ratio. We are currently in a period where gold and silver are gaining ground on almost everything else. The gap between the rising price of metals and the stagnating value of real property is where your future wealth is being generated. Historically, the time to rotate out of metals and into real estate is when the gold to housing ratio reaches an extreme low. In 1980, at the peak of the gold bull market, it took only 100 ounces of gold to buy a median-priced home in the United States. In 2011, that ratio dropped again to approximately 96 ounces. As of late 2025, we are approaching those historic levels once more. When the ratio hits these zones, you are not selling your gold because you want dollars. You are swapping your gold because it has reached its maximum purchasing power relative to land and shelter. The game plan for 2026 is simple. Ride the wave. Let the global debt crisis and the currency wars drive the metal prices to their mathematical targets. But as silver approaches $100 and gold climbs toward $5,000, you must have your exit targets ready. This is the moment to look for productive farmland or rental properties that have been beaten down in real terms. Imagine the power of trading 500 ounces of silver, which you might have acquired for $15,000 years ago, for a rental property that provides a steady stream of income for the rest of your life. You have used a non-yielding asset to capture a high-yield asset at a generational discount. Never touch the dollar during this process. Use the dollar only as a temporary mechanism of transfer. You are rotating from overvalued, non-productive assets, like gold in a mania, into undervalued, productive assets, like income-producing land or recession-proof businesses. This is how the rich stay rich across centuries of collapse. They use gold to survive the war, and they use that gold to buy the kingdom when blood is in the streets. 2026 will be your opportunity to perform the same maneuver. Stay patient, watch the ratios, and be ready to trade your dead metal for the live assets that will fund your family's future for generations. We have reached the end of our journey through the economic landscape of 2026. We have covered the systemic collapse of debt, the historical proof of purchasing power, and the silent war for global reserve supremacy. But all the knowledge in the world is useless without execution. As we speak, the window of opportunity is not just closing, it is slamming shut. We are moving from a period of high prices to a period of no availability. This is the final warning for those who believe they can wait for a better entry point or a clearer signal from the mainstream media. In the financial markets, there is a phenomenon known as a liquidity vacuum. It happens when the gap between the paper price and the physical reality becomes too wide to bridge. We saw the tremors of this in late 2025 when major mints began to ration silver coins and delivery times for gold bars extended from days to months. In 2026, we expect this vacuum to become permanent. A day is coming, sooner than you think, where you will log into your dealer's website or walk into your local coin shop, and you will see a message that says, "Out of stock." On that day, the dollar price becomes irrelevant. If you do not already have the metal in your possession, you are effectively locked out of the lifeboat. The division of society in 2026 will be simple. There will be those who have physical assets and those who have paper promises. When the central banks finally pull the trigger on the digital dollar and the old system is retired, the paper promises will be revalued at the whim of the state. Your gold and silver, however, will remain outside of their control. They are the only assets that have survived the collapse of every empire and every currency for 5,000 years. They do not require a functioning internet, a stable power grid, or the permission of a bank manager to have value. Your checklist for tomorrow morning is clear. 1. Audit your net worth and move toward a 15 to 25% allocation in physical metals. 2. Reach your 5 and 200 milestone with extreme urgency. 3. Ignore the daily fluctuations in the paper price and focus on your total ounce count. 4. Maintain absolute privacy about your holdings. And 5. Develop the courage to stand apart from the herd. It is not easy to trade your familiar bank balance for heavy bars of metal that pay no interest. It takes the mindset of a leader to prepare for a storm while the sun is still shining. We at Content Financial want to thank you for your time and your trust. We are building a community of men who refuse to be victims of a broken system. If this message resonated with you, share it with those you care about. Wake up your brothers, your fathers, and your friends. The tide is rising fast, but there is still time to secure your future. Stay safe, stay stacked, and we will see you on the other side of the reset.